There we go. All right.
I'm Ryan O'Rourke, and my project was on portfolio theory, and it was an analysis on the effects of using options as leverage on portfolio returns. I'd like to start off by saying thank you to Professor Wheatley and all the other econ profs that helped so much in creating our projects. We all worked very hard, but I think the econ profs worked even harder than us, so thank you. So to go through some of the terminology that you guys are gonna need to know to kind of understand the topic that I'm talking about, portfolio is a range of investments held by an individual or organization. Call option, so with the call option you're buying the right to buy an asset at a later date. So say I wanted to buy $100 on the S&P, I can buy the right to buy that later for $10 and then exercise that whenever I want to between now and when it expires. Leverage is the amount of debt used to buy assets, so it's using borrowed capital to expand your asset base. And in the money option is an option contract that, if exercised today, would be worth more than $0. The beta is the measure of volatility of an individual asset against the market as a whole. So it's how an asset moves relative to the S&P. An ETF stands for exchange traded fund, and it's a basket of investments that tracks an underlying security. So they'll take stocks that together they'll follow the trends of, say, the S&P or any other underlying security that you're trying to follow. Mutual fund is an investment program funded by shareholders that trades in diversified holdings and is professionally managed. So here are the steps that I took when running my analysis. So step one, I found the historical risk-free rate, volatility, and opening and closing prices on the S&P 500. Step two, I found the baseline comparison by calculating the yearly return on the S&P 500 ETF. Step three, I calculated option prices using the Black-Scholes pricing model. The Black-Scholes pricing model is considered the most accurate model to price options. Step four, I set up an alternative investing product. So I used 20% in the money call options on the S&P 500, with the remainder going to a municipal bond fund. So say I had $100 and I wanted to buy 20% in the money option on the S&P 500. I could buy, say the S&P 500 is trading for $100. I could buy that option for $20. So I'm buying the right to buy that $100 investment at a later date for $20. And then I can take that remaining $80 and invest it in something like a municipal bond fund. Step five, I compared the returns dating back to 1980, just because that's the furthest back I could get reliable data for all of my variables. Step six, I calculated the annual utility using the Markowitz and Jacobs utility functions that I'll get into later. Step seven, I estimated a CAPM market regression to find the beta of the portfolio. So again, the beta is just how it moves relative to the S&P. And then step eight, I reran the process for different levels of volatility just to see how different market conditions would affect the portfolio. So the main question I'm looking at is, will using options as leverage increase the returns of an investment relative to the S&P 500? The reason I'm using the S&P 500 is that it's a good baseline for the market as a whole. And then I'm looking at how the use of leverage affects the expected utility of an individual. So my outline, I'm looking at the theoretical connection between using leverage and increased portfolio returns. I'm looking at the connection with leverage and the efficient market frontier that I'll get into next slide. And then I'm looking at using in-the-money options as my leverage tool. And I'm combining those in-the-money options with a municipal bond fund. So the efficient market frontier is the set of optimal portfolios that offer the highest expected return for a given level of risk. So if you're increasing your risk, you're not going to do that unless you are expecting a higher return, because you wouldn't take on more risk for the same level of return. So as you can see in this graph, as the standard deviation goes up, the expected portfolio return is going to go up as well. And one of the things that using leverage does is, say I have like 10 stocks or something. If I use leverage, I can invest, say I have $100, if I use leverage, I can invest, because I'm borrowing money, I can invest $200 in that same 10 stocks. Whereas if you're trying to increase your returns without using leverage, you're going to have to concentrate your investment more, which is going to increase your standard deviation. So some of the literature, Scott and Watson, they're kind of the basis for the structure of the portfolio that I'm analyzing. The only difference is they used 3-to-1 leveraged ETFs rather than options as their leverage tool. Markowitz provides the base utility function that I use for my analysis, and then Jacobs kind of expands on the Markowitz utility function and adds a piece for the leverage part, because there's a leverage aversion with investors. So here's my empirical framework. So as you can see, the leverage piece is the 20% in the money option, and that's just the closing price of the underlying security minus the opening price, minus the option price, minus the foregone dividends divided by the opening price of the underlying security to calculate what the returns on that leveraged piece were. And then, like I said before, you're going to take that remaining money that you have from buying the option rather than the underlying security, and you're going to invest that into a municipal bond fund, which is going to provide you a spending floor. And that is calculated by the bond fund closing price minus the bond fund opening price plus the dividend. And then you just add those two together to calculate your annual return. So here's my portfolio return versus the expected return. And again, the expected return was calculated using a beta of 1.32. And one of the main things that they follow each other fairly closely, but one of the main areas that this portfolio outperforms the expected return is in recession years such as 2002 and 2008. And this is because the most you can lose on an option is the amount you paid for the option, because you don't have to exercise it if you don't want to. So yeah, the most you can use is the price you paid for that option, so you can't keep dipping down below that. And then here's the portfolio return versus the S&P return dating from 1980 to 2018. And again, they follow each other very closely, but those recession years is where this portfolio outperforms the S&P. And this is a look at how one of the main variables that goes into pricing an option is volatility. And this kind of shows you how, as you increase the volatility, the price of the option is kind of exponentially increasing. So that's one of the main variables you'd want to look at when managing this portfolio. And then here's my empirical results and analysis. So in 2016, the leveraged portfolio had a balance on an initial investment of $10,000 in 1980. It had a balance of $510,376 compared to a balance of $447,000 on the S&P. So it outperformed it by roughly $60,000. So the portfolio had an annual return of 11.2%, while the S&P annual return was about 10.8%. So it outperformed it by roughly 0.4%. And then I calculated the average Markowitz utility function, or utility equation for both the S&P and the portfolio. So the Markowitz utility function doesn't take it into account the leverage aversion aspect of this portfolio. But as you can see, this portfolio outperforms the S&P as far as utility for an investor. And it still outperforms it when you add in that leverage aversion piece that you see in the Jacobs utility function. So, yeah, additional changes that I could look at going forward. Look at different utility functions that better reflect this portfolio. Examine how different length of options, such as 2-year options, would change the results. One thing I'm trying to do right now is look at corporate bond funds and other types of bond funds to examine how that would affect the returns. I also need to look at like the tax implications of the portfolio. Since municipal bond funds are tax exempt, I think that this portfolio would actually outperform the S&P by even more than what I calculated. Look at different leverage tolerances. That's something I've been doing this past week, and I found that across all leverage tolerances, this portfolio still has a higher expected utility. And then I kind of want to look into more of like the key indicators of portfolio performance to see like which variables you want to keep an eye on the most to track how to manage this fund. So, yeah, any questions?
Yeah, I got a question. Can you go back to the graph where I think it's the first time we see the portfolio versus the, yeah, that one right there versus the expected return. Portfolio return versus expected return, right? So it looks like almost that so the portfolio return actually looks like it's versus the expected. It's like almost like hedging itself almost, right? It looks like, you know, it's not going to be as much gain as we expect, but it also is not much loss as we could have either. So it's kind of like minimizing the risk almost, right? Is that why we see like a high utility from investors? Is because we're almost like kind of like hedging our bets a bit?
So the reason for the high utility, so yeah, and this is pretty similar to the S&P 500 as well. It's going to outperform on those up years, but this, because of that floor, it's going to outperform on all those down years. Yeah, so the expected utility on those down years is a lot less negative for my portfolio than it is for the expected return. So to answer your question, I guess, yeah, it would be because of that reduced risk of like a recession kind of tanking your investment.
Sure.
Other questions from the audience? So I had a question, which I should have asked Josh, but I've given Josh a hard enough time, so I'm not going to do it anymore. So, what do you think you got out of the process? Like, what was the benefit of this process to you as a student and as you think about your future? So overall, the benefit of the 384 research process.
Yeah, I think the biggest thing that, regardless of whatever project I ran, is it teaches you a lot of data analysis skills, and it teaches you how to kind of compress data and analyze it and manipulate it to kind of look at a certain variable or something that you're trying to look at. So I think regardless of kind of which project you're doing, you're learning a lot of those data analysis skills that are gonna apply to whatever job you go into going forward. And just like the critical thinking skills as well.
Cool. All right. Mr. Nicolay?